So quickly, if we look at the bond market, what we do is we have this health score called First Capital Fixed Income Health Score, where we put in, we have the primary criteria and the secondary criteria. All the economic indicators have been put into that. And as you can see, the primary criteria, there's lots of upgrades that have happened over the years. Over the last few months. And then even in the secondary criteria, you would see that a number of upgrades have happened. So putting all that into the score, what we've seen is a significant acceleration in the score. So first, we've seen the score settle and bottom out in September 22, and a first acceleration occurring there with the IMF deal, and then with the board level coming in, a further acceleration coming in post-December. So we've come into the medium-low risk territory, which significantly eases pressure for interest rates and bring down rates drastically. So this is what we are expecting. So we've revised our expectation for the next 12 months. We are looking at a 400 basis point rate cut. So out of that 250, we are looking at during the third quarter, mainly in the next policy meeting on the 6th. We think there could be another big rate cut coming in, at least 250. So we're targeting to overall 250 for this year and another 150 basis point cut towards next year. So totaling to 400 basis points, with policy rates coming down to a range of 9 to 10%. And of course, these targets have already been hit with the DDO. So we were targeting 13 to 15% for the yield curve. So let's look at our next target. What we are looking at is the whole yield curve coming down to around 11 to 13.5%, with the further performance in the economic indicators, and also significantly supported by inflation drastically dropping. So our approach was to adopt a wait-and-see approach with the DDO not being confirmed at that time, but now we think there is further opportunities for you, as we explained that the yield curve may further come down. So let's look at the banking rates. We think the banking rates are likely to, over the next 12 months, come below the 15% mark. That is, the AWPR rate is likely to fall below 15% over the next 12 months. And looking at exchange rate, so we think in the short term, the currency will hold the current level of 280 to 320. However, towards December to next June, we have a rate of 320 to 360 that we expect for the currency. Why are we looking at a depreciation? With the economy opening up and trade relaxations coming in and GDP growth turning positive, with the economy starting to recover, we think there is likely to be more demand for dollar and a lot more imports coming in.